Hello and welcome. HMRC is rolling out one of the biggest shakeups to the UK tax system we've seen in decades. It's called Making Tax Digital for Income Tax. And to help us figure out what it all means for you, we're diving into an expert guide put together by the fantastic team at My Tax Accountant. They've laid out exactly what sole traders and landlords need to know, and we're going to walk through it together. Okay, we're going to start with just one single number, 2. Now, I know it doesn't seem like much, but trust me, when it comes to your taxes under this new system, this number is everything, and ignoring it could be a very, very expensive mistake. That's right, just 2 late submissions. Under the new points-based system, that is all it takes to get slapped with a £200 penalty. It's a much stricter way of doing things than most people are used to, and honestly, it feels designed to catch people out. So understanding these new rules isn't just helpful, it's absolutely essential.
But hey, don't worry, this guide has got us covered. We'll start by taking a closer look at that new penalty system. Then, we'll figure out exactly who is affected and when. We'll break down the new digital requirements, and we'll get used to the new quarterly rhythm. We'll also uncover some hidden challenges that the experts have flagged before wrapping it all up with a simple action plan to get you ready.
Okay, first up, those penalties. Now, it might seem like a bit of a grim place to start, but honestly, understanding the consequences is the best way to avoid them. You see, HMRC has designed this new system to target consistent lateness, not just a one-off slip-up.
And this is where the difference becomes crystal clear. A lot of business owners are already familiar with MTD for VAT, right? With that, it takes 4 penalty points to get a fine, and those points disappear after a year of good behavior. But for income tax, whoa. The threshold is cut in half to just 2 points, and they hang around for a full 24 months. The takeaway here is simple. The rules for sole traders and landlords are much, much tougher.
So, with those stricter penalties in mind, we get to the million-dollar question. Does this actually apply to me, and when does it all kick in? Let's get right into the crucial dates and the income thresholds you need to know about.
The rollout is happening in 2 main stages. The first wave kicks off in April 2026. This is for all you sole traders and landlords out there whose qualifying annual income is over £50,000. Then, a year later, in April 2027, that threshold drops to £30,000, which is going to bring a whole lot more people into the system. So, the best thing you can do right now is check your income to see which group you'll be in.
Now that term, qualifying income, is critical, and it's so easy to get this wrong. We are not talking about your profit here. This is your total gross income, your turnover, before you deduct any of your expenses. And what's more, it's the combined total from both your self-employment and any property income you have.
Let's make that even clearer with an example. Imagine you're a freelance graphic designer based in London, and your turnover is, say, £27,000. You also happen to rent out a flat, which brings in another $25,000 a year. Well, your total qualifying income is £52,000, which puts you firmly in that first group starting in April 2026. What's really crucial to remember is that any income you have from a PAYE job or from dividends or savings does not count towards this MTD threshold.
So now that we know who is affected, let's talk about what you actually have to do. This is the practical side of MTD, and believe me, it represents a real shift in how you'll manage your finances day to day. We're not just talking about filing online. This is going to change how you keep your records entirely.
And this brings us to one of the most common questions out there. Can I still use my trusty old spreadsheet? The answer is, well, it's a yes, but with a pretty big catch. You can definitely keep using a spreadsheet for your records, but you can't just upload it to HMRC anymore. From now on, it has to be connected to HMRC's systems using special MTD-compliant bridging software.
The new system really boils down to 3 core jobs for you. First, you've got to keep all your business records digitally. Second, you have to send a summary of your income and expenses to HMRC every single quarter. And third, you submit a final declaration by January 31st to wrap everything up. This is a huge move away from that one big annual deadline to a more continuous year-round process.
Now, when it comes to the tools you'll need for the job, you basically have 2 main choices. You can go for an all-in-one software package that handles absolutely everything from record keeping right through to submissions, or if you really love your current system, you can use that bridging software we mentioned to connect your existing spreadsheets to HMRC. The key thing is that whatever software you use, it must be on HMRC's list of recognized providers.
So let's talk a bit more about that new rhythm. For decades, self-assessment has revolved around one massive deadline. MTD completely flips that on its head. You're effectively moving from one big annual submission to 5 separate touchpoints with HMRC throughout the year.
Here are the new deadlines you'll need to get in your calendar. As you can see, you have 1 month after the end of each quarter to get your updates submitted. So for the period ending on the 5th of July, your submission is due by the 5th of August, and so on. Now, a really important point here. These are submission deadlines, not payment deadlines. You're just sending data. The timing of when you actually pay your tax bill isn't changing.
Okay, we've covered the what, the who, the when, and the how. But the experts at My Tax Accountant have also flagged some lesser-known issues that could easily trip you up. These are the pro tips. And you'll want to stay with me. These next few points are the ones that could save you a real headache down the line.
Here's the first pro tip. If you're a brand new sole trader or a landlord just starting out, you might think you can just jump straight into MTD. But nope, you can't. HMRC's rules say you have to file at least one traditional self-assessment tax return the old-fashioned way first. This means, in your first year or two, you could be juggling 2 different systems, which is a bit of an unexpected hurdle to say the least.
Next up, a very specific one for landlords. If you own a property jointly with someone else, trying to keep perfectly separate digital records for each person's exact share of every single expense, well, it can be a total nightmare. Thankfully, HMRC recognized this and has introduced some easements, which are basically simplifications that allow for less detailed records. It's a very, very welcome workaround.
Here's another pro tip, and it's about a common shortcut. Currently, smaller businesses can submit a simplified 3-line account, just total income, total expenses, and profit. The good news is this option is continuing under MTD, but, and this is the crucial part, it does not remove the underlying legal requirement to keep full digital records of every single transaction. It's a reporting shortcut, not a record-keeping one. That's a trap a lot of people could fall into.
And finally, this one is a biggie, especially for businesses that use a bookkeeper for the day-to-day stuff and an accountant for the year-end finalization. As it stands right now, HMRC's system doesn't allow multiple agents to access the same client's MTD data. This could cause some serious logistical headaches. Now, HMRC knows about this, and they've promised to fix before the 2026 start date, but it's definitely one to keep a close eye on.
Right, we have covered a huge amount of ground. I know, we've looked at the new rules, the deadlines, and those sneaky hidden challenges. So let's bring this all together into a simple, actionable plan to make sure you're 100% ready.
The guide boils it all down to 4 simple steps you can take right now. Step 1. Confirm your start date. Dig out your last tax return, add up your gross income from self-employment and property, and see if you're in the 2026 or 2027 group. Step 2. Assess your records. Be honest with yourself. Are you on spreadsheets, or is it still a shoebox full of receipts? Step 3. Start researching software. Go to the HMRC website, look at their list of recognized providers, and see what fits your needs and your budget. And finally, the most important step of all, plan your transition. The absolute worst thing you can do is leave this until the last minute. Start planning your move today.
Now, before we finish up, it's really important to say that the information we've talked about today is for general guidance. Tax rules are super complex and they can and do change, so please don't rely on this as your only source when you're making financial decisions.
Look, making tax digital is a huge change, and as we saw right at the start, getting it wrong can be costly. If you're feeling a bit overwhelmed or just want that peace of mind, the best thing you can do is seek professional advice. The team at My Tax Accountant who developed this guide are genuine experts in this field. You can reach them for tailored guidance on 0208 570 8531, or you can drop them an email at info@mytaxaccountant.co.uk. Please, don't wait for the deadline. Get prepared today. Thanks so much for joining us for this breakdown.